Hello, everybody. Welcome. This is it's KESO Intermediate Accounting, 17th edition. And this is my solution walkthrough for the textbook by the authors Don KESO, Jerry Weingate, and Terry Warfield. This is for problem 19.9. The question used in the presentation is copyright 2019 by John Wiley and Sons. All rights are reserved for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. This solution presentation is copyright 2019 and 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky, not the authors of the textbook or of Wiley. Okay, let's go ahead and get over to the party. So right over here. So we've got problem 19.9. We're over here. We're dealing with our deferred income taxes, which is always fun. But let's go ahead and start over here. So what we're going to do is for this particular question, we're going to start over here. We've got our pre-tax financial income. We've got our tax rate. We've got some differences here. Then we've got taxable income is expected to be as expected for the next few years. It's short-term in nature, and B and C are long-term in nature. Okay, so right over here. But as we know, all deferred taxes are not current. So let's go ahead and get to it. So our pre-tax financial income is $100,000. And what we're going to do is we're going to say, okay, well, this is for financial statement purposes, right? So this is on our financial statements. What we now need to do is to adjust this to get to the taxable income. So warranty expense accrued for financial reporting purposes. So we debited warranty expense, and this was for $7,000. But for tax purposes, the warranty costs were only $2,000. Okay, so over here, we're taking a deduction for warranty expense to get to this $100,000. But for tax, we're only allowed $2,000. So this is going to be a $5,000 difference. And this is going to essentially be an add back. Now, what's happening with this warranty expense is that this is going to be in the current year. Now, we're going to be paying $5,000 more in terms of taxable income because we're only being allowed a $2,000 tax deduction. However, this is going to reverse in a future period. So we're going to get this deduction later on, just not now, but the current year impact in terms of computing what our income tax or taxable income is going to be at $5,000. Let's take a look at letter B. So over here for letter B. Okay, for letter B, gross profit on construction contracts. Using the percentage of completion methods per books was 92,000. Okay, so gross basically profit per percentage of completion was 92,000. Okay, so gross profit using percentage of completion, 92, but for tax purposes, it's only 67,000. Now over here, for tax purposes, well, I showed income of 92,000 when I was coming to this 100,000, but for tax purposes, I'm only going to have to show 67. So over here, this is percentage of completion adjustment. And this is going to be for a negative $25,000. Now, so I'm paying $25,000 less in the current year because for accounting purposes, my income is 92, but for tax purposes, it's only 67. So over here, right, so I've got this 25,000. So I'm going to go ahead and deduct that. And what's going to happen is in future years, this is going to go ahead and reverse and cause taxable income to me because this will drop for income financial reporting purposes, and then this will be increasing for tax purposes. Okay, let's take a look at letter C. Okay, depreciation on property, plant, and equipment. Okay, so over here for depreciation, let's give ourselves a little bit more room, always nice to do. So for depreciation for financial statement purposes, this is going to be 60,000. But for tax purposes, I'm getting a deduction of 80,000. So over here, what I'm going to have to go through and do is I'm going to be taking in another deduction of $20,000. And as a reminder, so again, for books, I deducted 60, but for tax, I get to deduct 8. So right over here, I'm going to get to deduct $20,000 more for my book purposes, but as nothing is free in Waterworld, I'm going to be paying for this later. So over here, I'm going to be going through and dealing with this 20 in the future. So this will be future periods. Okay, so that's A, B, and C. Let's take a look at letter D. This is going to be what is known as a permanent difference. I paid a fine, okay, that for violation of pollution laws, that was deducted in computing pre-tax financial income. So I took over here, this is a pollution fine. So over here, I took a deduction amounting to 15, actually not 1,500, that was for the next one, 3,500. So I deducted 3,500. But for tax purposes, they're going to say 0. So what I'm going to have to do is basically adjust this difference by essentially going over here. And I'm going to be adding this back. So I paid a fine. That fine was deducted in determining my pre-tax financial income, but it's a permanent difference. Under the tax laws, I'm not allowed to take deductions for that. So I'm going to have to add that back. Now, unlike these up here, these are temporary differences. This is a permanent difference. So if I paid a fine, I deducted it to get over here, I have to add it back because I'm not allowed to take that deduction for tax purposes. Then I've got municipal bond interest. Okay, now my muni bond interest over here, I put in 1,500 of income, of interest income, getting to this 100,000. So this is adding it in. However, it's not taxable. So what I'm going to do over here is that I'm going to basically take this out. I don't have to pay tax on it. So I'm going to go ahead and show this over here as a deduction. Okay, so this is how we go ahead and look at this. When it says that this one here is short-term in nature and B and C are long-term, all this is going to be long-term because it's going to be, or non-current because it's going to be reversing in the following year. So my taxable income for 2021 is going to be $62,000. Okay. Now, when it comes to going through and handling this next part, the first thing I always want you to go ahead and do is we're going to basically, the tax rate is 20%. So my income tax expense current is going to be 12,400. So what we're going to do is we're going to start up on the journal entry. Okay, so this right here, we're going to go jump directly to C because that's going to help us get to the answer what they're asking for in B. So right over here, for this, I'm going to have income tax expense current. My income tax expense current is going to be 12,400. I'm going to have income taxes payable current, and this is also going to be 12,400. So the first thing you always want to do in these questions, and this is kind of what I'm going through and learning, is that you want to go through over here and you want to first go through and show, okay, this is what's happening over here. Okay, so income tax expense current, income taxes payable current. Now, the next thing we're going to do is we're going to figure out, okay, this is for the future periods. We got 5,000 and then we have 45,000. Okay, right. So right over here. Okay. So When it comes to this 5,000, this is, I'm paying more tax on this now, right? I had to increase my income. So what this is going to be is this is going to be what we're going to go through and call a deferred tax asset. And I'm just going to show this over here just so we can kind of go ahead and look at this a little bit separately. So when I take 5,000 and I multiply it by 0.2, I get a negative 1,000. And this is going to be a deferred tax asset. So how do I go through and record assets? I'm going to go ahead and record those with a debit. So I'm going to have deferred tax asset for 1,000. Okay. Why is this an asset? Because I'm paying tax on it now. I'm going to get the benefit later, right? Now and later. It sounds like a candy that we were all growing up with. Okay. So let's go over here to the next one, which are the next two, I should say. So when we look at the percentage of completion adjustments plus the depreciation expense, this is 45,000. This is going to be a liability. Why is it a liability? I'm not paying tax on it now. I'm going to have to pay tax on it though later. So my tax rate is at 2%, or excuse me, 20%. So over here, I've got 45,000 times 20% or 9,000. This is going to be a deferred tax liability. Okay, so I'm going to have over here deferred tax liability, and this is going to be for 9,000. So over here, I have a deferred tax liability. This is going to be for 9,000. Now we come to the fun part, kids, is that we're now looking at this over here and we're saying to ourselves, okay, do I balance? And the answer is no, right? But our balancing entry is going to be what we're going to see right here, which is going to be income tax expense deferred. So over here, what do we need to do to go ahead and make this balance? Well, it's going to be $8,000, which is really the difference between the deferred tax asset and the liability. But this is going to be income tax expense deferred. So this is the journal entry. Again, the steps that you probably want to go through and do to tackle these questions. So to record. The steps I would do: step 1, determine your taxable income. Step 2, figure out what is your current income tax expense. The next thing you want to go through and do after you have those is to figure out your deferred tax asset, your deferred tax asset, your deferred tax liability. You're going to put those in. Whatever I need to do to balance is going to be my income tax expense deferred. So that's where we are right there. Let's now take a look at what else they're asking us to do. So compute the deferred taxes that relate to temporary differences clause, to clearly label them as deferred tax asset or liability. We just went through and did that. So we're totally good. Okay, that's how we do it in the journal entry. Down over here, draft the income tax expense section of the income statement beginning with income before income taxes. Okay, so my income before income taxes. Okay, this is not changing. This is going to be over here. This is for financial statement purposes. Less income tax expense current, less income tax expense deferred. And so my current income tax expense was $12,400. My income tax expense deferred was $8,000. So my total income tax expense is going to be $20,400. So my net income is going to be $100,000 minus $20,400. Something that's really important here, and I'm going to share this with you just because I want you to kind of understand. If you look at the book solutions, and I'm just going to show you something right over here. So if I look at the book solutions, notice here that the income tax expense is showing $20,400. Okay, and I'm just going to go ahead and change my share back to here. So, but if you notice this, I'm breaking this out in the journal entry. It still equals 20,400. But why am I breaking it out? Because it's helping me better kind of, if I do it like this on the journal entry, when it comes to doing the tax provision, it's going to be that much easier to go through and do. So that was problem 19.9. I look forward to seeing you on the next video. And as always, I really want to thank Wiley for allowing me to do this. They've been extremely generous, and Wiley's position, and this is something I really truly agree with, is that as a student, as of right now, this is fall or is this spring of 2022, you can pretty much find any answer to any question on a textbook on Chegg. And what was really interesting is that the rep from Wiley, she shared with me, well, Bennett, would I rather have you explain it to the students so you can actually learn something from it? Because what I'm doing here is certainly not giving you answers, but it's really about giving you the better education. So again, I really want to thank Wiley. Their intermediate accounting textbook is amazing. They've come out with the 18th edition. So we'll go back to some of my videos and see what we need to update. But in any event, I look forward to seeing you on the next video, and have a great rest of your day.